There's been a lot of discussion amongst us here about the stock market's rapid rise and the growth of corporate earnings over the past several years. And so we're hopeful today to discuss sort of the corporate earnings landscape, the credit landscape, and how that lines up with the current stock market valuations.
Yeah, corporate earnings, last year, no earnings growth. So let's take that out of the equation and then extend that back to the last 3 years, which have been more of the tax cut and cash repatriation influenced earnings. There you have seen positive earnings growth, but a very significant chunk of that has been due to stock buybacks. And that also flows into the corporate debt side, because what's been happening, a lot of companies used cash from overseas to bring back to the US and buy back their stock, used earnings, but more so what we saw was issuing debt at very low interest rates in order to take that debt and go buy back your own shares. So a lot of the earnings growth is not necessarily from growing the E in earnings per share, but it's from reducing the S in earnings per share. We should be approaching the limits of this type of activity because you're at a record level of corporate debt as a percentage of the size of the economy. And a lot of companies have borrowed to the point where their credit outlook is negative, or maybe they might be facing some potential downgrades.
You said there hasn't been any earnings growth, but so what's been driving earnings growth, and where has it been?
There are certainly winners and losers. More domestically focused companies were able to generate positive earnings and revenue growth, like healthcare, utilities. And then generally we saw the losers were if you receive a larger portion of your revenues from outside of the US, and then if you're tied to a more cyclical industry, things like materials, industrials, energy companies, because we had a big cyclical slowdown last year, manufacturing slowdown. So those companies were the losers. The expectation is in 2020 that you should get somewhere mid to high single digit earnings growth. So we should return to earnings growth. And that assumes a lot of things. One is a reversal of everything that happened last year.
Okay.
So if you have more of your revenues overseas, you're going to be better off. If you're more cyclical, you're going to be better off. And if you're domestically focused, you'll be sort of flat.
Okay.
So our view is sort of a little bit more muted than that. We think somewhere single to mid earnings growth is more likely.
Okay. Any impact that we anticipate from the coronavirus in disrupting the global economy?
It's too early to tell in the US, but a lot of US multinational corporations have had to shut down a significant number of their stores. For example, Starbucks is one example. They had to shut down a big number of stores in China. So it's too early to tell, especially for US companies. There is expected to be a somewhat notable impact on Chinese economic growth. Could be revised down 1.5%. So we'll see how it plays out and how it develops. But at this point, probably not a notable impact in the US.
Okay.